Have you ever heard terms like LP, GP, preferred return, 8% brush? Or maybe you've heard somebody say that they invested in a 100-unit apartment complex and they don't deal with the tenants at all? How in the world does that work? It all sounds super complicated, right? Well, in this video, I'm going to break down exactly how passive multifamily investing works, clearly and simply. Hi, I'm Megan with MG Investment Ventures. We invest in multifamily real estate, and we partner with investors who want exposure to large apartment communities without becoming landlords themselves. Now, before we get into structure and numbers, I want to say this. Passive investing is not about chasing the biggest return. It's about understanding the structure, risk, and alignment. And if you understand these three things, you're going to be way ahead of most investors. So let's start at the beginning. When most people think about real estate investing, they picture buying a rental property. You close on it, you renovate it, you find tenants, and you fix things when they break. That's active investing. You're investing capital and you're investing time. You're making decisions, you're managing people, you're responsible for the performance. And for some people, that's great. They want control. But here's my honest question to you. Do you really want another job? Because owning and operating rentals is definitely a business. But let's contrast that with passive investing. As a passive investor, that means that you invest capital into a larger real estate project, but you're not involved in day-to-day operations. You don't manage tenants, you don't handle maintenance, you're not negotiating contracts or overseeing renovations. Instead, you invest in a team that does all of that. And this is where LPs and GPs come into play. Let's say you're a busy business owner. You don't want to be dealing with HVAC repairs, right? But you still want real estate exposure and have that part of your portfolio. So this is where passive investing starts to make sense. In a multifamily syndication, there are two primary roles, the GP and the LP. The GP is the general partner, and they are the operating team. They're the ones that find the property, analyze the deal, secure financing. They raise capital, they execute the renovation plan, they oversee the property management company, and eventually they refinance or sell. They are active. The GP is the one signing on the loan. They're responsible for the execution of the business plan, and they're the ones that carry all of the operational risk. And at MG Investment Ventures, we operate on that GP side of things. On the flip side, we have the LP, the limited partner. And the limited partner is a passive investor. The LPs invest capital, they own a percentage of the property, they receive distributions, have limited liability, and are not involved in operations. Limited refers to limited involvement and limited liability. They're not signing on the debt, they're not managing contractors, and they're trusting the team to execute the business plan. Think of it like this. The GP runs the business, the LP owns a piece of the business. Or another way to think about it is that the GP is the quarterback. The LP is the owner of the franchise. Both are going to benefit when the team wins. They have very different responsibilities there, right? Now let's talk about one of the most common terms you'll hear, an 8% preferred return. Here's what that means. If you invest $100,000 into a deal with an 8% preferred return, you are entitled as an LP to receive the first 8% annual return, or $8,000 in this case, before the GP participates in any profit splits. It's important to understand though, that a preferred return is not a guarantee, it's a priority in how the profits are distributed. If the property produces enough cash flow, LPs are paid first up to that preferred return. After that, any remaining profits are typically split between LPs and GP. For example, a 70% to the LP and 30% to the GP. And it's this structure that aligns incentives. The GP only participates monetarily when the investment performs well. And this is important. The preferred return structure exists to align incentives. It tells the LP investors you're prioritized, and it tells the GP we perform well together or we don't win together. When you review a passive investment opportunity, you'll usually see a few different performance metrics. So let's quickly clarify what those mean. Cash on cash return measures annual cash flow compared to your invested capital. So if you invest $100,000 and receive $8,000 distributions in a year, you have 8% cash on cash return. It measures income. IRR is internal rate of return. And this is a sophisticated metric that tells you how efficiently your capital is projected to grow over time, taking into account cash flow timing, return of capital, and sale proceeds. And then we have equity multiple. This measures the total growth of your investment. A 2x equity multiple means that you've doubled your money. If you invested $100,000 and received $200,000 back total, that's a 2x multiple. Each of these metrics measures something different: income, timing, total growth. Understanding them helps you to evaluate opportunities intelligently. One thing I always emphasize is that projected returns are based on assumptions. Assumptions about rent growth, expenses, market conditions, and exit timing. Higher projected returns typically require more execution, and they're definitely going to carry more risk. Whereas more conservative projections might look less exciting, but they're going to offer more resilience. And remember that passive investing isn't about chasing the biggest IRR. It's about alignment. Does the risk match your goals? Does the timeline fit your liquidity needs? And do you trust the operating team? These matter more than the big headline numbers. If this helped you better understand how passive multifamily investing works, let me know in the comments. My goal is to make this space more transparent and easier to understand. If you're exploring passive investing and want to learn how we structure opportunities at MG Investment Ventures, then reach out to us directly. We can't wait to speak. I'm Megan, and thanks for being here. I'll see you in the next one.